All right, good afternoon, everyone. Tiffany Mueller here with the Abrego team. As most of you know, Stephanie and I are both experts in real estate, but not in lending. So we wanted to give you some advice from an expert in the lending field to kind of help you a little bit today as we're kind of navigating through a little bit of a crazy market. And people are always kind of asking questions as to what they should do with lending. So I have Steve Stearns here with Thrive Loans. So Steve, you want to say a little bit about yourself?
Yeah, thanks, Tiffany. Yeah, I'm Steve Stearns with Thrive Financial, and I run a small local mortgage brokerage. And I started in the business in January of 1992, and I work together with three of my sons, producing loans locally.
Yeah, three. I only thought it was Chris. So three. So I'm able to relate, obviously, because I work with my mom, so that's kind of nice. But anyhow, like I said, I'm going to mention a few questions that people kind of continue to ask and see how that's able to maybe help some of you. So one of the questions that a lot of people say are, they're concerned about writing an offer, let's say, that's contingent upon them actually selling their home in the market because of how competitive it is right now. They feel like they might not get a home because of that contingency. So what do you think about them writing offers that are not contingent on them selling their home, even though they need the proceeds? Do you have any options for them in regards to that?
Yeah, so I think this is maybe the biggest conundrum in today's marketplace is, there's multiple offers. I'm going to count on probably 10 offers on any home, basically, that's under $1 million. And when a seller's looking at those offers and they see a contingent offer, they're probably just going to pass that offer and go right on to the next one. So I have been brainstorming with people on how they can write a non-contingent offer, but still effectively be able to close.
Right.
So, one of the ways that I do that, like somebody that I just spoke to yesterday, is the parents are willing to help. So the parents are going to give us gift funds for the down payment, and we'll do a gift affidavit, and they will show us a gift. It will be a gift, but then once the other home closes, then the kids that are buying the house will then pay the parents back.
Okay.
There are other ways we can look at going non-contingent as well, which is if the person doesn't put their home on the market right away, they could show that home as a rental so they can still qualify for the new home. Okay. So we're gonna pretty much, when I talk to every client, my very first goal is looking at how can we go non-contingent on this offer, because otherwise they're probably not going to get their offer accepted.
Right, yeah, because it's just difficult right now. I've found that a lot with people. Fortunately, we've gotten a couple offers accepted that were contingent, but obviously, we want to help people as best as we can to get it accepted. So another question is, what should the buyer do, let's say, if the seller requests in the counteroffer to remove the appraisal contingency? That's happening a lot. Or even when you write the offer, not to have the appraisal contingency. So what's your thoughts on that?
So this is super common. If the client is putting a decent sized down payment, so let's say we've got an $800,000 home and they're putting $300,000 down and they're getting a $500,000 mortgage. What I'm going to explain to that client is, it doesn't matter if that appraisal comes in at 800 or 750 or even 700, I can still deliver the $500,000 mortgage to them at the identical terms, regardless of whether that appraisal comes in $50,000 or $100,000 low. Okay. So with that particular customer, I'm going to tell them, as long as you're comfortable paying how much the offer is for that home, regardless of what the appraisal is, there's really no need to have an appraisal contingency. Okay. Where it's going to get a little bit trickier is if we've got a client with 5% down and they have no additional funds, they don't have any money in their 401k they can pull out, they don't have any family funds they can borrow, then we probably don't want to remove their appraisal contingency, because the appraisal comes in low, they could potentially lose their deposit. Right,
exactly. Okay. And then what about, let's say if a seller requests in the counteroffer to remove the loan contingency, which is a little bit of a bigger deal.
So I'm going to come back to you and say, oh, not a big deal at all.
Okay.
And here's the reason I say not a big deal at all. I've got the experience with 29 years in the business. When I qualify a client, I know what they're qualified for. Many times I'm actually helping the underwriter that's less experienced understand the file so that they approve my client's file. Okay. So I can tell a client that I'm 100% certain. I just told clients last night, I don't care if you have a loan contingency, you're going to get the loan unless you lose your job.
Right.
And we typically remove loan contingencies 14 or 17 days into the process. And if they lose their job after that, they wouldn't get a loan. So that's one, Tiffany, actually, that I feel super comfortable having my clients remove the contingencies.
Okay, right, which would give them a big advantage too. Right. Another question was, what happens if the property doesn't appraise at what both parties agreed upon in the contract? But that kind of goes back to what you were saying before, right?
Yeah, and there's one other piece that just popped into my mind when you said that is, I'm teaching clients that have good credit scores, if they're putting 20% down and the appraisal comes in 5% low, now they've got an 85% loan to value loan. That adds a 0.11% mortgage insurance. But if you think that they're getting a 3% interest rate and you add 0.11 mortgage insurance, would you like to buy the home and pay 3.11%? Or would you like to walk away because the appraisal came in low?
Right.
Because chances are in this marketplace, in another marketplace, the seller might lower their sales price.
Right.
But here, when they've got backup offers and 10 offers coming in, normally they're going to say, pay my price or I'm on to the next offer.
Right.
So that's one of the best solutions when the appraisal comes in low is add a little bit of mortgage insurance, change their loan slightly, but that might add $50 or $100 to the monthly payment.
Okay. Okay. One of the other things, can a buyer ask the seller to pay for closing costs? And I would say don't do that in this market, but what's the answer to that?
A buyer can do whatever they want, right?
Exactly.
But I would say it's completely insane because you're going to be up against 10 offers. None of the other ones are going to ask for closing costs. So if I've got a client that's tight, I'm going to explain to them, hey, instead of me giving you a 3% interest rate, let me give you a 3.25% interest rate, which should give us about a half to 3/4 of a point. So maybe $5,000 to $7,000 that I can pay your closing costs for you rather than the seller.
Okay.
So effectively, we're not allowed to finance closing costs, but that's kind of what we do is we raise the interest rate a little bit. I use a lender credit rather than ask the seller for it.
Okay, yeah, that's a good idea. So buyers are obviously having a really hard time right now getting their offers accepted at the 10% down. What advice would you give them in terms of options with that? Like what options do they have?
So options that I'm going to buyers with, I'll give you a real life example that just happened this week. So a client's name is Andy, mom's name is Sue. Andy wanted to put 15% down on a condo in Irvine. It was a competitive situation. Mom gave us a gift letter, said she would give Andy another 15%. So he wrote his offer with 30% down. We showed mom's bank statement, we showed the gift letter. Now, the offer got accepted. Andy's qualified with 15% down. So we're going to go ahead and write his mortgage at 85% loan to value and close it. But he does have the wherewithal and mom is willing, if necessary, to come in with the extra 15%.
Right.
So effectively, Andy's getting his offer accepted by using his mom's gift funds, but in reality, he's not going to use them to close the transaction.
Right, but he has those there and it's kind of, I think, showing the seller that the confidence that if they need it, then they can use it.
Exactly.
Right. Okay. So just kind of a simple question, what can the buyer basically expect in terms of closing costs for a new loan, approximately?
So I'm going to say most of our buyers are buying in the range of $700,000 to $900,000. If they're going to have impounds on their mortgage, meaning they need some money up front for taxes and insurance, they can count on about $11,000 to $12,000 worth of closing costs, including title, escrow, lender fees, everything.
Yeah.
If they don't want to have impounds, they're looking at about $7,000.
Okay. So what's today's kind of current interest rate? What does a monthly payment, let's say, look like with 10% down at, let's say, a $700,000 home?
So I went ahead and took notes for this
Yes.
since I was prepared for this. So
Yeah.
with 10% down, and I went $900,000, $800,000, and $700,000 loans.
Okay.
I used a 3% interest rate. We might be 2.875 today, but I just sort of like the round number of 3%.
Yeah.
And with the 10% down payment, total payment, including taxes, insurance, mortgage insurance, the whole thing, $4,619 with 10% down on $900,000.
Okay.
If we go to an $800,000 sales price, principal, interest, taxes, insurance, $4,120. And if we get on to a $700,000 sales price, $3,620.
Okay. All right. So that gives people kind of an idea as to what they'd be looking at. Okay. And then lastly, where do you project the lending market to go over the remainder of the year and kind of into 2022?
Well, since my crystal ball is broken, and I'm a research guy.
Darn it.
I did some research.
Okay, good.
So Freddie Mac actually put out figures on April the 14th, and they showed for the first quarter of this year, the average 30-year fixed rate, so they take surveys of a lot of lenders, was 2.9%. By the fourth quarter of this year, of 2021, they're expecting it to be 3.4%, and by the fourth quarter of 2022, 3.8%.
Okay.
So we're looking at about a 0.5% increase over the year this year,
Right.
and another 0.5% increase next year.
Okay. All right. So we're still good, but obviously it's, I think, beneficial if people can get something now. You know, they have the lower rate. So
Yeah,
Okay.
Tiffany, I did a comparison that I told you about earlier with a client yesterday, and if sales prices fall $50,000 on an $800,000 home to a $750,000 home, and at the same time interest rates go up 1%, the client's payment is actually higher by $150 at the lower sales price with an extra percent in rate. So it looks like we're going up about 1% in a year.
Right.
So that's going to equal more than $50,000 worth of sales price, more like $70,000 worth of sales price in difference. So I definitely encourage people that are they don't want to buy high, but I encourage them just take the good interest rate and buy what they're qualified for.
Right. All right. Well, thank you so much for your time, Steve, and we're just grateful to have a little bit of kind of clarity on what some of the buyers can do in today's market.
You're very welcome.